Welcome, I'm Angelo, Mena. In today's segment we're going to be looking at tax depreciation and quantity surveying. Tax depreciation is one of those wonderful things that the government's put in place for investors as an incentive to investors. And to tell us more about this, we're going to be speaking with Tom Plenty. Tom's the Director of BMT Tax Depreciation. Tom, why don't you tell us a bit about yourself?
In the mid-1990s I was doing project management, and at that point there was an opportunity in the market to look at tax depreciation, and a friend of mine at the time, who's now a business partner, we came together and we formed BMT to focus on tax depreciation. Quantity surveyors are generally people who estimate construction costs, and that's what we are, but we focus on one part of doing that, and that's doing depreciation schedules. So that's what our focus has been, and that's what we continue to be, and we've sort of grown from 2 people in a small room to now we employ about 95 people around Australia. So,
well, why don't you tell us a bit about tax depreciation and how it's an advantage to an investor?
Okay, well, as an investor in residential as well as commercial, but focusing on residential, you're generally negatively geared, and what the depreciation is a non-cash tax deduction. So that means that you're claiming a deduction without actually having to outlay the cash to claim that deduction. So typically on a residential property you'll claim a residential house, for an example, you'll claim $6,000 to $8,000 a year in depreciation of that property, depending on its age though. So if we go on to the age of a property, the newer the property is, the more depreciation you're likely to claim. But having said that, older properties still claim depreciation. So for example, the legislation that affects part of depreciation came into enforcement in 1985, and that affects residential property. Commercial, industrial type properties, they came at a different time, so just depends on what type of property you have. So a property built in 1990, for argument's sake, still has a significant amount of depreciation left in it. A property built in 2000 still has a significant amount of depreciation. However, over time, your depreciation goes down to zero, and for residential property, the time period is approximately 40 years for a property built new now. So if you buy a new property, it'll go for 40 years. Now what we do is we prepare a report that breaks that depreciation down into the 2 main components, which are the Division 43, which is the structure, and that is the walls, the floors, the ceilings, windows, the roof, those type of things. Those are the hard aspects of the building which the Australian Taxation Office give an effective life of approximately 40 years. And you can claim that at 2.5% per annum. So that 2.5% per annum on a line ball gives you a 40-year lifespan. Right. The other part of the depreciation, which is termed Division 40, is the plant and equipment aspect of the building. Now those are things that the tax office has decided or are otherwise given down to being items that have a lower effective life. Now, plant and equipment covers all sorts of things from trucks, cars to different types of machinery, but inside a house or a residential house or residential property, it covers things such as your carpet, the blinds, the hot water system, the stove, other things like that have an effective life that is less than 40 years. So what we do is we separate the building cost, those components out, which is Division 43, and then separate the plant and equipment out, which is HO term Division 40, and that gives us the 2 main aspects of depreciation. We then break down the plant and equipment aspect again further to differentiate what rates of depreciation you can claim against different items, and it goes even further than that to be different rates get into different systems of depreciation, which, if you understand correctly, you can maximise your depreciation claim by putting those items of plant equipment into different rates in different categories.
Can you give us an example of that?
For example, if an item is less than $1,000, you can generally pool that item, and that pooled item gets a higher percentage in the first year and subsequent years than if the item was unpooled, for argument's sake. If a stove is worth more than $1,000, it will get a lower depreciation rate because it's based on its effective life than a pooled item, because a pooled item has an overall rating where it gets 18.75% first year and a higher rate again the second year and the year after. So what it is a method which you can pool all your assets less than $1,000, and then and then all your items above $1,000 you claim the actual effective life of that item, which the HO sets out.
Okay.
So it gets more complex than that, even though, because when an item is when a property is owned by 2 people, you can then have a pool because you own half, and say I own half. An item worth $2,000 is then worth $1,000, which can then pool for each individual. So it becomes a little bit more complex because the rates at which you can apply to different items differ in value because I own half and you own half.
Okay. Now, depreciation is an interesting thing because you can go into a house, let's say you go into a house that you would consider as a renovation property.
Yes.
You think there'd be no depreciation, but there's something called scrapping as well, isn't there? Can you tell us a bit about that?
Yeah, well, if you say you buy an older property and it needs work, or you've had a property for some period of time, and you need to you think you may need a new kitchen or a new bathroom and a whole heap of other work that needs to bring it up to date, for argument's sake, and you'll get a better rental return. Then those items that you have in there, for example, you take out the kitchen, you might have a residual value on your stove, a residual value on a range hood, all those type of things, or even on the kitchen itself. And you remove those and basically throw them out and get no retained value for them. You can scrap that, and whatever the written down value is of those items, you can claim that as a 100% deduction the year you do it.
Okay.
Okay. Following on from that, you then install the new kitchen and put in a new stove, new range hood, etc. You can then claim depreciation on those new items from that new starting point.
Yeah.
So what it is effectively is if you have items in your property that still have value attached to them, but the benefit to you is that I suppose the overall concept is you're renewing your property to get a higher return. You still get to claim the deduction that's left in those items that you haven't claimed yet.
Okay. So the take-home message would be, especially to someone who's going to renovate a house,
yes,
really consider getting a
report based on before you remove any of the items, because it has a value in there. There may be both Division 40 and Division 43, which I've mentioned before. And Division 40 is the plant and equipment, which is your stove and your hot water system and other things such as that. If they're in working order and they have a value attached to them, if you have a property that, and we get examples all the time where it more happens so in commercial property where the property may only be 5 or 10 years old and there's significant renovations done, and that's where items of Division 40 such as walls, floors and ceilings, which still have value attached to them, are demolished and removed and thrown away, for want of a better term. Then you can claim the depreciation that was relevantly left in those items that you haven't claimed yet.
I think the whole concept of depreciation fascinates me because on paper, after 40 years, you can pretty much write off the value of a house to zero. If you take a 100-year-old bluestone villa, that's clearly not worth nothing.
Nothing,
right?
no. What you're depreciating is the economic value of the property in its constructed form. So what the ATO says is the walls of this dwelling we're in now has a tax effective life of 40 years. So over that period of time, you're going to spend a significant amount of money redoing various parts of the building. That's why the plant and equipment aspect, the carpet and the light fittings and things like that have a lower effective lives, have higher rates of depreciation. And I suppose when you're talking to maximise your depreciation, the idea or the concept to do that is to maximise the number of those items and the value that they attract, so that gets higher depreciation than 2.5%, which is the main structure of the building.
Okay. I guess in your opinion, why do you think the ATO put depreciation in place? I mean, they didn't have to do it, did they?
No. What it is though, if it encourages people to invest in new dwellings. For example, if you're going to spend $300,000 building a new house and renting it out, if you cannot claim any deduction or value for your actual $300,000 initial input,
yep.
Say you own a block of land, say it's worth $100,000 and you spend another $300,000 on the property, then you've got a value of $400,000, perceived value of $400,000, but you have no. If you went and invested in a car, the car depreciates over time. The house will still depreciate over time, and the value, initial $300,000 you put into the property has depreciated. It's the land that's gone up. It's not the building itself.
Exactly. So I guess, like claiming against your interest, claiming against the depreciation as well is really the government's way of being able to create an incentive for people to go out there, buy property, rent them out, so the government doesn't have to do it. That's
correct, yes. And particularly is important with respect to other aspects that are coming in now, for example, energy efficiency and green power, etc., where there's incentives for those type of things going beyond depreciation. It's actual government money coming in to support those items. But the idea is that where you can accelerate your depreciation of items, that will attract money to invest in those items.
So Tom, what's the advantage of being able to maximise your depreciation benefits at the beginning?
Okay, what it does is to give the investor a helping hand in those first few years where they've had initial costs of purchasing the property, they've had a lot of costs associated with getting tenants and maintaining the property, and then its initial stages, and that'll give them a helping hand over the first 5 years of ownership. Yeah.
And so then it would be fair to say that after that first 5 years, rents go up as well?
They will most likely do, yes. And then depreciation does taper off, but it might be, say, $6,000 to $8,000 in your first, say, 5 years per annum, but then over the next 5 years after that, or the second 5 years, it would be somewhere between, say, $4,000 and $6,000 a year. So it doesn't taper off to zero. It does decrease, and then it becomes a steady sort of stream. But you do get more in the initial 5 years because your plant and equipment has depreciated over that period of time. But your Division 43, which is your structure, has a consistent depreciation over the period of time.
Okay, and after that 5 years, you'd expect the rent to be many thousands of dollars more.
Well, that would be the objective anyway, yes.
With regards to depreciation, is there a difference between houses and units?
Most definitely. The units do attract a higher depreciation, especially in their first 5 years, than houses do. There's one simple reason for that, is that units have a higher proportion of plant and equipment in them than the house or an individual freestanding house does. Now that is mainly due to things like lifts, car parking systems that have extractor fans and multiple access systems, pools, gyms, even things like that. All those things attract a higher depreciation than what you will find in a house, because those things simply don't exist in an equivalent individual house. There are other things, for example, air conditioning that could be in a house or may not be in a house that will most likely be in a unit, and those things that generally add to the depreciation rate of a unit. The other thing is units are a lot more complex to build. They generally cost more on a per square metre basis, and they have a lot more complex systems in them. Houses, for example, the standard residential investment property, it may or may not have air conditioning. It'll have stove and hot water systems and things like that, but it won't have the complexity that a unit generally has in it. In the mid-range of that, though, you'll find the townhouse, and that townhouse has common areas which even if it's a two-storey townhouse on ground with no basement car parking, you'll still have common area lighting, common area driveways, other things such as this that give it a higher depreciation than a house will be, because the house generally doesn't have those items because it's an individual house. Yeah. So the size of the property also impacts depreciation. For example, a lot larger house with more fittings, fixtures, more bathrooms, a lot more landscaping, hard landscaping, that is, retaining walls, etc., driveways, garages, obviously has high depreciation because the construction cost is high. Yeah. The other thing would be renovations, which we did touch on briefly, but people often see, for example, an old bluestone house, and they'll go, okay, it's an old house built 150 years ago, and they'll go, no, there's no depreciation, but a lot of the time they've been extended, say a property was extended 10 or 15 years ago, then there's Division 43 and Division 40 in those items as well. If it's had internal renovations but not extensions, there's still significant depreciation left in that. Provided the product was done, say, post 1985. So 1985 is your cut-off date, residentially anyway. Significant depreciation exists post that. It's just prior to that there's only Division 43, which is the plant and equipment, and generally speaking, that's pretty much written off by it's 25 years ago.
So Tom, what's the take-home message in all of this then?
Really, what we do is we put more money back into people's pockets. We give them a bigger deduction, which the ATO is going to give them money back for, or they wouldn't have had to pay that tax for in the previous to us being there. So what it is we're giving people money for our service.
That's great. Well, look, thanks so much for that.
No problems. Thanks for inviting me. Much appreciated.
Thank you.